All right, we're looking at the NASDAQ CFD, and it has ran out its relative equal highs on the 15-minute time frame. And there's a small little fair value gap in here on the 1-minute chart on the right-hand side. I'm not really interested in that. I'm more interested on the 15-minute time frame bearish order block, which also has the 1-minute fair value gap just above the one I have annotated here. Around that 15,920. And you can also see that low on the uppermost 15-minute candle on the left-hand side. And I'm drawing your attention to where I believe the market's going to draw down into. So that is my tradable objective. So framing this, if I can get it to run to 15,920 and bump that 15-minute bearish order block and fill in the 15-minute time frame fair value gap that's on the left-hand side. Okay, we just went through the 1 minute and we're taking it up into, looks like that 15,920 level, which again would bump the bearish order block. I'm interested in that as a sell. What I'm showing you here is how you would forward test. That way, for the folks that are asking, I'll shade in the fair value gap here, and it'll also line up with the 15-minute bearish order block. Okay. And I would hypothetically sell short there either on a limit or right now. That's a market order. I would do that. And the stop I would use about 15 to 20. We'll look around that 15,940 level. And I'm thinking from that run right there, it should not make another higher high, and it should gravitate towards that sell side liquidity pool. Okay. Put a hypothetical stop loss in here. Now this is what you would be doing for forward testing without demoing, so that we are not looking at the money, even if it's paper money. Okay, and you don't want it to be a draw, or not draw, but a tug of war of pain and suffering or sugar highs. Okay, you don't want that to happen in your development. So while you are learning the concepts and you're testing them going forward, testing them going forward with forward testing analysis. You're not trying to be right. You're just observing and logging. And every time you find something that is noteworthy, like right now, this would be a good area to do a screen capture because we're getting a reaction off of that fair value gap on the 1 minute chart. I'm showing you where I ultimately would like to see it go, but that's one of the better objectives, but we don't need that. And that would be down there a really, really best case scenario. Like that would be if we completely fall out of bed, and given the market's dynamics today and underpinnings, it doesn't look like it's all that energetic today. Dollar indexes. Hang on here. Get this typed out right. Okay. And then by looking at all the, like the dollar index, the euro, it's all small little ranges. Volatility is really, really small and low. But those are the targets I'd like to see if it completely falls out of bed. But I'm taking your attention to those relative equal lows that's shown on the 1 minute chart. And forward testing, the idea that we're essentially trading at a bearish order block on a 15-minute time frame with a market maker sell model. Now, you might not be looking at that 1 minute chart thinking, oh yeah, that's an obvious market maker sell model. There are times when the market maker sell model and buy model only has one return. For instance, a premium market right now, I would go short here if I wasn't already. And it should not trade higher than the high that's already formed, where I have my little trend line with the little arrow anchored to. Looks a little close there, Michael. But I would want to see it fail here. Now, retail traders would see that as a bull flag on the 1 minute chart, and they would expect it to keep trading higher. I'd rather see it hold where it's at, not make a higher high. That's what I'm looking for. So that way I would hypothetically be entering on the highest candle into that fair value gap on the 1 minute chart, which is also the 15-minute time frame bearish order block. So it's bumping up against that lower time frame, and I'll anchor that so you can see it now. And let's change the color and the thickness here so that way it really pops on the 1 minute chart. So right now this would still be a good short, and you can see we're banging up against it right there. So with ICT vision, okay, if there is such a thing, you would be seeing it like this and say, okay, this is going to go lower based on institutional order flow, based on the draw and liquidity. Sell side liquidity resting below that 15,790 is just too juicy not to go for. And we're seeing some initial confirmation in price action. It's showing a willingness to repel. Notice the bodies of the candles on that 1 minute chart. It's providing the clues that it doesn't want to go. And I'll show you that I have not taken any trades. I've not used anything. I'm doing exactly what I'm teaching you. Sit on your hands. But just because we're in a low probability condition doesn't mean you don't go in and do like forward testing or back testing. Now, back testing is where you just go back and look at where it worked and study why it was working, what was there in terms of price action signatures, what algorithmic theory, and flesh out the underlying narrative that the hindsight provides you the benefit of. When you're forward testing, this is how you disconnect yourself from the pain and suffering of not doing it right, even with your demo account, because some of you are realizing now I want to see it trade through that fair value gap. Like it needs to go right through that. But if it comes back up to it, like see now we completely closed it. I want to see it go through it entirely on that 1 minute chart. This is why I'm having it noted on there, because if we trade down through it a little bit more, and if it comes back up to an excess resistance, that also would be an area where I would look to enter or add. All right, so far it's stalling just a little bit. If you look at the 1 minute chart, we're sitting right on that down close candle. That's technically a possible bullish order block. So it might struggle a little bit here on that 1 minute chart, but the narrative is we're going lower, and I want to see it go down, take out the sell side liquidity pool below that 15,790 level. So we have a nice breakdown into that down close candle, really nice right there. So I want to see it trade right back up into the 15,089 level. If it does, I would hypothetically add another entry there, basically pyramiding. But if it just keeps on cascading lower, it doesn't make a difference. But for the purposes of what I was teaching the other day of how I build up the demo accounts and run the balances up is I'm pyramiding. And if I get the opportunity to do, well, I may not do it now because it just took out that short-term low on the 1 minute chart, just above the 15,860 level. So the chances of it returning back to that fair value gap now before running out the relative equal lows is very, very slim. In fact, I would not want to see it go back up to 15,089 at all before running out the lows at 15,790. Now, in your forward testing, notice that we don't have a demo entry here. There's no hypothetical, well, not hypothetical, there's no psychological tug of war going on about being right or wrong. Notice that? We're just relaxing. We're just watching price. We're annotating things, and everything here is hypothetical in the same way a demo account is, but I'm going to lower the stop loss here. Hold on 1 second. All right, so the stop now is below entry. So if it comes back up and runs the premium high on that fair value gap. I don't want to be in that. Remember what I just mentioned? I don't want to see it trade back up even to the discount low of it at 15,889. I don't even want to see that traded to. So this could be a potential area for you to take a partial profit. I don't want to do that here because I want to illustrate a little bit more depth of prognostication, but this could be a partial for you. So you would annotate your chart and show that this is a first partial. And this is how you would do it here. Let's draw a line here, make it a little bit thinner, and then put a little annotation here. Oh, let me fix that right there. All right, and this would be like you would annotate your chart first partial there. And let's put it under. It's going to be a little cramped until I magnify the chart. That's okay, so it'll work. All right, so that would be your partial. So you would be in technically hypothetical profit, and your stop would be at a point where if it comes back and runs on you, you have about 19 handles of profit. Never mind that it's been 80 handles in profit for this run already, which is wonderful. If you were trading the NASDAQ futures contract, that would be 80 times 50 bucks. Real nice. So American traders, by the way, let me get this here. All right. Now, American traders, let me put this here, draw your attention to it. So I'm looking for speed and deliver under those lows now. But CFDs, we can't trade those in America. They're basically banned by the Commodity Futures Trading Commission. And the benefit of me showing you this US 100, I'm not trying to entice US traders to trade with this because we're not technically allowed on US soil. But for the benefit of those outside the US, like in the UK and such, in Germany, you can trade these CFDs. And they are very close, but not exactly to what you would see in the NASDAQ futures. And I normally pose this market as a means of studying the indices without having to pay for live data. So in other words, what I'm showing you here, it's close to what the price movements are in the NASDAQ E-mini futures. Okay, so while they're close and very comparable in terms of how they deliver price, just remind yourself that you can't trade these legally. And if anybody in the US, like on YouTube or whatever, and they're showing they're trading, making $12,000, $50,000, $80,000 in US 100, and they're living in like New York or California or Miami, they're most likely lying to you using a rented MT4 server or its demo, because they can't trade legally with CFDs in the US. So I just want to put that in there as an additional disclaimer. I know I mentioned why I've been doing this, and we're seeing a nice run here. Let me get back to this chart. The intention is just to show you the price fluctuations and movement using the CFD data with the US 100. But in the States, as a US trader, we would be using the NQ, which is the actual mini futures. Or you can trade the micro. It's the mini, you get like $50 per handle, and you can get like $5 per handle on the micro. So it's a market that you can trade, you can access. It doesn't require a lot to trade micros on this with the actual futures contract. And you get far better precision with the futures market versus the CFD. The CFD is a little off in terms of its precision, but the futures market is absolutely precise. Like you can get the actual turns right on a quarter of a handle. So a quarter point move and a quarter point order block or objective, many times you'll see it deliver right to that and not one quarter point or quarter handle beyond it. It's just it's really nice to know that these things, these concepts work in other markets, not just Forex. All right, having a little bit of a retracement in here. So I've moved my stop, and I've probably should maximize this chart. Getting a little cluttered up here. So I got 50% of the position that would come off if it goes below 15,790. Let's maximize that now. All right, so you can see it. So this is a 15-minute bearish order block framework. And I'm just changing this here so that way it looks a little bit easier on the eyes. All right, and now what I have here is, let's assume for a moment you had, I don't know, let's say it was 100 lots. And I know most of you can't do that, okay? But let's say it's 100 lots or 100 contracts of the NQ. And we're using US 100 here as an example. The first partial would be like 25 contracts coming off on the first partial. So that first partial would have a balance of 75. So if it trades below 15,790, you would take that 75 and divide it in half. And we'll just do better than that. We'll say it's 40 of the 75 that we'll take off. Okay. So if it trades below there and expands down, we'd wait for it to go below it and have a nice big beefy bodied candle stretching down. That's what you want. You don't want that little tiny peak below it. You want to see it spread open with a nice deep run, because that's where you're trying to get the best positive slippage on your exits. Positive slippage is where you're trying to get out of a move and it moves in your favor. Not you're trying to get out, but it comes back against you before it fills you. That's negative slippage. Okay, see if we can get a dive under that level. So far, this has been a pretty good run. Now, as you're developing, if you wanted to take something off here as a partial before it gets to that level, do not be afraid or feel like that is failure or cheating or less of an astute trader. You want to learn to take screenshots like I'm doing here. Okay, so that would be something you would screen capture that. I just want to file that away for a moment. But we want to see a nice, big, beefy bodied candle, spread lower. It's 50% of the balance now. Okay, so 50% of the balance is now off. And then technically that would be like 65 contracts of the 100 that were initially entered is now in profit. Leaving 35 on balance with a stop at 15,880. Okay, and you can see it's been a nice decline from where our hypothetical 15,920 entry would be. And that's what it looks like with the 15-minute time frame on the left. I personally would like to take another partial here if I were in it, because we're sitting down there below it. I don't have the lines from the 15-minute chart on the left, on the right. So we'll just use what we got here. Okay, so so far not a bad little objective. Hit 2 partials potentially 3 or 4 if you were wanting to take something before it ran out to relative equal lows. There's nothing wrong with that. That would be a nice cover right there. 15,765. That was good. In an ideal world, it would just fall right from here. But any retracement in here back into like where the first partial was taken, that's where resistance would be expected by retail traders. And I wouldn't want to see that. If it goes back to that level, it becomes less likely to go lower, at least during the morning session. And we would have to wait for it to go through the New York lunch. Right now it's 10:46, so it's likely to retrace, obviously, because we had a nice decline since the 10 o'clock hour began. So 145, 150 handles on this example at the highest level, and we're getting a little bit more retracement in here. Now put that in perspective. Let's say you pulled out 150 handles at $50 per handle. That's a big chunk of money, isn't it? Much more than most of you probably earn in a month. And that's not trying to belittle anyone. And this, to be honest, like that's a nice amount of money. Even if you did one contract, $50 per handle, and 150 of them, that's a nice chunk of money. And if you did that, once a month or cumulatively over a course of a month, that's good, really good living. I can remember back as a 20-year-old, if I was making that kind of money and that's all I did, and I didn't try to do more or try to be a nutcase about trying to figure out how everything worked, I probably would have been better. But seeing a little bit more retracement, it's probably going to pop above those relative equal highs. There's a small little fair value gap on that 1 minute chart. We'll see if we want to dig into that. But this is, if you look at the 15-minute time frame on the left, you see how this doesn't make any sense for it to come back this deep. So while it looks permissible on the 1 minute chart because that's that small little fair value gap that it's just trading into now and above the relative recent highs on that 1 minute chart, it's just cleared. The 15-minute time frame tells you a different story. Like, it should not be doing what it's doing right now. So that's, to me, it's problematic. You might look at that as, okay, it's just rebalanced. Remember, we like to see gaps remain. We don't want to see them completely close in, okay? That's not entirely accurate for traders to think, well, every imbalance needs to be rebalanced. No, absolutely not. IPTA, the algorithm that delivers these price action moves, will leave clues for interbank traders. Now, this isn't obviously the Forex market, but the same algorithm, the logic, the code is used in all these electronic markets. Some of them have little subtle nuances that are more specific to one asset class over another, but by far and large, they're very close to what they do across all assets, which is one of the reasons why, again, I hate crypto, because it doesn't have those transparent signatures that are obvious in all the other markets. But just to showcase and illustrate again further that if Forex became something of an impossibility, or I got an email from someone that said, hey, all this COVID stuff and the moronic or Omicron or whatever, it's an anagram of the new variant they call it. Its anagram is moronic. everybody's freaking out about it or whatever. I think it's the byproduct of the people that got vaxxed. And I promise I won't go into a rant about all that, but the concern was, in the student's email, was everyone in all the countries are trying to talk about going into a cryptocurrency. They want a cryptocurrency of their own national currency. And will this cause Forex to become obsolete? I'm not worrying about that. I'm not losing any sleep over it, because there's other markets like indices, like commodities, like stocks. So I'm not concerned. Okay, I understand for new students, you're learning this and you're excited and you want to be proficient with it and you see a long career in front of you using it. It gets back to that same question of, is it going to stop working because of this or that? If you live your life worrying about if it stops working, you're putting yourself through misery. There's no reason to worry about that, because the markets are going to trade in other asset classes and they'll get better. And if all the currencies go to a crypto, then that might be the final, thing I need for the crypto markets to be as efficient, because they're not right now. They're far better than they were 10 years ago, but they're not, they're not where they need to be for me to trade them. All right, we'll see if it wants to fall in here. We went inside that fair value gap on the 1 minute chart. It needs to drop in here if it's going to do so. It's consolidating. So I'd like to see it drop down and get into that, what is that, 15,810, 15,800 level, and accelerate through that on the downside. If it fails to go through 15,800, then it's probably going to want to retrace back up to, well, it would probably go into my stop. But that's okay. We're going to stick with the idea, because we're not psychologically or emotionally committed. We're not worrying about being right or wrong. We're not worrying about money. We're not, there you go. Let's draw this out here. And then we'll just focus on the details, not the money, not the right or wrong. We're just trying to study price. We're trying to get a feel for what it's doing, and this gets you closer to the marketplace. This is all tape reading. Okay, this is how you train yourself. You may have annotations on your chart, and then the market goes right on through what you think might be happening. Don't look at that and think, oh, I'm wrong, it's a failure. Take that in. Screen capture that as well. Like this right here. Like I have the fair value gap here, and the bodies are respecting the discount low of it. That's promising. It should drop from here. It should trade lower. It should trade, in my opinion, through the 15,800 level definitively, and just slice through it like a hot knife through butter. But let's play devil's advocate here. Partial on. What's it? Bounce. And there we go. So I have another target there using that swing projection. So if it gets down there, that'll be a third partial, and I would take 50% of the remaining bounce, and that would be 20 contracts of the remaining 40 hypothetically. So 40's on balance right now from the original 100. All right, so we're seeing it drop down in here. I want to see it go through 15,800. And so far so good. Looks good. I don't want to move my stop. I want to leave where it's at, because I want to keep it away from nearby price action, because it's out of sight, out of mind then. And I know you all want to jam it down and kind of like protect, but you got to give it some breathing room. And even if it does come back at this point and stop me out, that's always going to be a possibility in your trade. You have to accept that, which is why taking partials, and why I teach taking partials, is how successful traders fund and pay themselves. You cannot be profitable without taking profits, okay? And it's not about your lines meeting your targets, okay, or these candles reading your objectives, okay, meeting them. That doesn't equate to success, because you might see that happen, and then greed kicks in and says, well, it might move more, and you don't let your limit orders activate. You move your limit orders out further. See how easily just using my candle hit my line or my levels, if you're not executing, you're not profiting. You got to be able to take profit. So this here is problematic. I don't like what it's doing here. Yeah, this is too much stalling. See the 15-minute time frame chart? See how it just, we should be already lower. Yeah, we should not be going back above or even returning back to that fair value gap on the 1 minute chart. I personally would close the balance here, but we'll just stick with it for the purposes of how you would engage. You would study this little fair value gap here and then get another clone. Put that here. It could sell off from here, but I don't like the idea how long it's spending in this area. And I don't want it to go back above here. So let's have a note here. Must stay below this premium. Forgot how to spell premium there for a minute. Premium array. Spelled right here. 2 R's. There you go. So it needs to stay below that, and it's already went above the fair value gap I just annotated. So see what's happening here? Yeah, this isn't, it's going to probably go right for my stop. That's okay. It's illustrating, again, no fear, submit to the process. You want to see these things. These things provide experience. It'll probably run right into my stop now. And that's okay. 65 contracts or the equivalent in a price action move that was highly precise, very, very precise. Walk through with you, real time, over the shoulder. Yeah, here comes this one to bump me. Almost got it. There it is. Okay, that would be a stop out. Let's note that. And stopped out on balance. Let's spell that right. All right, and next setup. And that's how you would leave it. And you would screen capture that. And then you'd have a new experience. Maximize this so you can see it. So from the 15-minute time frame bearish order block and fair value gap on the 1 minute chart down into a liquidity pool, relative equal lows, 65 contracts or the equivalent of, with about 145 handles on NASDAQ. That is really, really nice. Okay, and I think that's going to be it. I'm not going to do any analysis today because the markets are quiet and this was enough. I want you to kind of like use this as an example going forward and be inspired by it. And until I'll talk to you tomorrow for our weekend commentary, find insight from this, and I'll talk to you then. Be safe.